Financial freedom means having a steady income stream that covers your living expenses, even if you don't work constantly. Achieving this requires acquiring assets that generate money for you. But which assets not only provide cash flow but also offer protection against market downturns and inflation? In today's video, we'll explore 5 such assets to help you quit your job. Before we dive in, please like the video and subscribe for more great content on money and investing like this. Let's get started. Number 1. Dividend stocks. Owning stocks in strong companies can provide regular income without requiring active work. These companies distribute a portion of their profits to shareholders as dividends, which are cash payouts. The amount of these payouts varies among companies and is referred to as the dividend yield. Dividend differs from company to company. For instance, Apple has a dividend yield of less than 1%, while Verizon Communication has dividend yield that exceeds 6%. This yield is a percentage of the stock price, so a company with a 10% yield on a $100 stock pays $10 annually per share. However, dividend yield is just one factor to consider when purchasing stock. It's crucial to invest in financially stable companies with strong future prospects. Incorporating dividends into your consistent cash flow is a long-term strategy, particularly if you don't have significant capital to invest upfront. For example, to earn $1,000 per month from dividends with an average yield of 3%, you'd need a portfolio worth $400,000. This demonstrates why dividend investing is often a long-term plan. Many investors leverage compound interest and reinvest their dividends to grow their investments over time, eventually generating substantial regular income. Despite being a long-term strategy, dividend investing is an excellent addition to your cash flow, as this type of income is highly passive and typically taxed at a lower rate than regular income. Number 2. Cash-generating real estate. People often say real estate is one of the best paths to wealth, and they have good reasons for it. First, real estate generally appreciates over time. For example, in the early 1990s, houses in the U.S. typically cost around $97,000. Today, the median home value exceeds $400,000, meaning the market value has more than quadrupled in the last 30 years. Second, you can own real estate without having the full purchase amount upfront. Consider buying a $200,000 house with a $40,000 down payment and borrowing $160,000 at a 2.5% interest rate over 30 years. Your monthly expenses, including mortgage payments, interest, insurance, and taxes, would be $830. If you rent the house for $1,200 per month, after covering expenses, you'd have $370 left each month, resulting in an annual profit of $4,440. The beauty of real estate is that your asset is being paid off by someone else, building equity while the property's value increases over time and generating positive cash flow. Additionally, real estate offers strategies to expand wealth. Some investors refinance properties as their value increases to buy more properties. For instance, if your $200,000 property appreciates to $250,000, you could refinance and take out $50,000 in cash. You could then use that $50,000 to purchase another $200,000 property. This way, your initial $40,000 investment allows you to control $450,000 worth of real estate, doubling your cash flow with 2 income-generating properties. Number 3. Bonds. Bonds today aren't often seen as great investments due to their low returns and inability to keep up with inflation. However, they can still provide a layer of protection against market downturns, especially for those nearing or in retirement. Warren Buffett, the renowned investor, once said that if he passed away before his wife, he would advise his manager to keep her money in a very specific, yet simple, portfolio. He suggested investing 90% in simple index funds like the S&P 500 and 10% in bonds. Finance professor Javier Estrada tested this strategy using historical market data and found that it outperformed many expert recommendations for retirement investing. Estrada added a twist to maximize the protective benefits of bonds in an investment portfolio. Since market crashes are unpredictable but inevitable, it's crucial to have a strategy, particularly for those who are financially free and living off their investments. Estrada recommends that retirees monitor the market's performance when withdrawing money from their investment portfolios. If the market is performing well, withdrawals should come from the equity side, which is generating the highest returns. Conversely, if the market is struggling, withdrawals should come from the bond side, as bonds typically increase in value during bear markets. This approach allows equities time to recover in value instead of being sold at a loss. Number 4. Cash-flowing businesses. There are numerous lucrative businesses not listed on the New York Stock Exchange. These can include physical businesses like restaurants, coffee shops, franchises, or ATM machine chains, as well as online ventures such as applications or software companies. The aim is to own these businesses without having to operate them yourself. Running a business requires a unique skill set, and not everyone possesses the necessary expertise. However, many people own businesses and hire individuals to manage operations in exchange for a good salary or equity in the company. This type of investment tends to be more complex than other forms. It might involve starting a business from scratch and working until it becomes self-sustaining, or finding businesses in need of investors or partners. Alternatively, you could buy an already established business or franchise. Despite the higher level of difficulty, this approach offers significant benefits, such as control over cash flow and profits. As a business owner, you also enjoy numerous tax advantages. For example, you can utilize the dividend distribution tax, which is usually lower than regular income tax. Additionally, owning a business allows you to spend some of the business's money before taxes, as long as the expenses benefit the business. For instance, if you own a business with multiple stores, you can buy a car using the business's funds for store visits. Since it's a business expense, you can purchase or lease the car with pre-tax money. Always consult with a professional to understand the specifics of what you can and cannot do with pre-tax money. Number 5. Startups and growth companies. How many of you have ever wondered, what if I had invested in Amazon 20 years ago? How much money would I have now? Or perhaps you've thought about getting in early with companies like Uber or Netflix. While we can't go back in time to invest in those major companies, new companies are constantly emerging that have the potential to become just as successful. Investing in these kinds of companies can be highly profitable, but they also come with significant risks. Savvy investors typically allocate only a small portion of their portfolio to these high-risk investments, fully aware that these ventures could result in a loss. However, if they choose the right company, their wealth can skyrocket, reaching entirely new levels. While these investments can be lucrative, the best investment you can make is in your own education. Real estate can be a fantastic investment for those who are knowledgeable, but for those who aren't, it could lead to disaster. Similarly, stock investing can build long-term wealth, but without financial literacy, great opportunities might be missed. Investing in your own education lays the foundation for successful investing and creating the life you desire. Thanks for watching. If you enjoyed this video, give it a thumbs up, let me know your thoughts in the comments below, and hit that subscribe button. Don't forget to turn on notifications to catch all my future videos. See you next time.